One of the biggest problems I see is that people just don't know what they can do. All their life they've gone to one bank. They don't know that there's other structures and other things that they can do to improve their situation.
If you don't have your foot in the door right now with some sort of investment, you are burning your cash to the ground.
There's 3 areas of investment. You can invest in your own name, you can invest in superannuation, and you can invest in. As business owners, we are grinding every day. When we finish the grind for work, we come out of that space and we think about our personal life and our personal holidays. We just spent all this time focusing on work that's time consuming, takes forever to build. We don't want another thing that takes forever to build.
So if your goal is financial freedom, but you're living in your own place of residence and paying down the mortgage, it's very unlikely you're going to achieve financial freedom.
Problems with property investment. One is, what are you willing to make a decision on? And the other one's,
what if you could take $100,000 and turn it into $5 million, $200,000 and turn it into $9 million? Today's podcast guest has done that for one of his clients, and he's also helped thousands of others build their property portfolio on their path to financial freedom. And there are so many misconceptions you probably aren't aware about, such as paying down your mortgage, living in the home you buy, all these things that are complete BS unless you have the right strategies and structures in place. Today we have Aaron Wybrow from Strategic Mortgage Brokers, who's going to help you learn how you can build financial freedom through property. It gets better as we go along. Enjoy this episode. So Aaron, you have helped my wife and I build an $8 million property portfolio when we were told we couldn't keep borrowing. I know a lot of people will look at that in Australia and go, fuck that guy, because there's a lot of judgment in tall poppy. But today we're going to be discussing how anyone listening at home, whether they're a successful business owner or a nurse or somebody working in a hard role like that, how they can actually start building their property investment and wealth journey. So I'm very excited for today. Thank you for being here. How are you feeling?
Oh, feeling pretty good. I'm stoked. Let's see what we can do to help people.
Amazing. So let's just dive right in. Like, what are the common misconceptions you see when it comes to Australians and building wealth? You know, we have clients that are paying down their mortgages, which is, in my mind, a terrible idea. What are the biggest problems you're seeing when it comes to building wealth through property?
One of the biggest problems I see is that people just don't know what they can do. They are all their life they've gone to one bank. They've got some money from that bank, but then they can't get any more from that bank, and they don't think that there's extra banks out there that can do more things. They don't know that there's other structures and other things that they can do to improve their situation. And they just need, like, people in the end are just wanting to provide for their families. Mm-hmm. So it's about what do you want to do, and that there are more options than just the bank you've always been with, or the common understanding from parents or from kids or from the barbecue out of the weekend about what you can do with property versus what you can't.
Yeah, and I hear that a lot from people that are in property. Is like, I need to buy my family home as soon as possible. I need to pay down my mortgage. I don't want to go outside the big banks. So obviously that happens because of the way we're raised. What are the consequences potentially of doing those things?
Yeah, so you can take it from a number point of view. If you are going to do those things of getting your own home and paying down your debt and and you don't have a goal, and that was fulfilling your goal and filling your life mission, you can do that. And if it fulfills you, go for it. Mm-hmm. But if you're looking to build that long-lasting wealth, and in the current day and age with everything that's going on in the political world and everything that's going on with governments printing money and all that stuff, we do need to invest. Mm-hmm. And we do have to think about it differently. I think we have governments throwing money hand over fist for people to buy their first home versus, and then they complain about a rental crisis at the same time. And you go, well, property investors are providing the properties for the rental crisis, and owner-occupieds may be building more properties, but there's a whole range of things there that what are we doing? We're just running after things that we think are viable versus understanding what we actually want in life.
Yeah. So how do we figure that out? Because I know for me and Rosie, it's very clear that if we can get to $10 million of property, and that property can go up by 10% a year. On paper, we don't have this money. We're making $1 million a year every single year for the rest of our lives. And that's if we stop now and we don't plan on stopping. And I think a lot of hardworking men, they grind in the business, they grind in their career, and they feel like they've got nothing left over. Whereas the way I look at property and the way I look at my business is it's a vehicle to fuel my investments. And how many business owners and hardworking men, they make a shitload of money. They don't keep any of it. And they're stuck in that rat race, stuck in that hamster wheel. So how does somebody shift their mindset around property and look at it as an investment vehicle to fuel their dream life? Like, how do you set those goals?
Yeah. So I think investing is a necessity right now. And it doesn't matter totally what business you have, because even if you have a business that you can sell at the end of your time, you're probably not going to be able to retire on the proceeds of the sale. So everyone's going to have to invest on the side. I think as business owners, we are grinding every day, and I'm not immune to that either. I'm grinding every day. I run a business. We've got staff and all those pressures, and it takes time. And I think the time thing is something that really mucks around with our head when we're trying to invest, is that when we finish the grind for work, we come out of that space and we think about our personal life and our personal holidays, our cards, our investment goals, all that sort of stuff. And we want that now because we just spent all this time focusing on work that's time consuming, takes forever to build. We don't want another thing that takes forever to build. So, and that's where I think we need to think there's some shortcuts in business, coaching, looking at our peers, and with investing, there are some shortcuts around. If we can manage our cash flow right, we can then get into some of the more complex lending structures and things to be able to help us go further, faster. So we still have to give property time because it's the last hurrah of delayed gratification in my world. Because I know there's lots of people, if you don't have any money in your bank account, you can go down to ASICs and you can get a brand new pair of ASICs, click your Afterpay and away you go. But if you can't do that with property, you can't just have nothing in your bank account to go on after property. It's like, and it's hard to get into, it's hard to sell, all that stuff. So it's a bit like, you've got to think about it like your business. It takes hard time and slog to get your business going. It's going to take a hard time slog to get your property going. So I would advise everyone to build them together.
Yeah, 100%, because there's this misconception, I'll invest when. And for me, with my property journey, it was always the moat, right? So business is hard, business is stressful. My line of business, there's more competition, ad costs are getting higher, the cost to acquire a customer is getting higher. So I started 8 years ago. Our first property was $188,000 in Rotorua, New Zealand.
Love it.
We put in 40 grand. That property is now worth 540 grand. So it's gone up almost $400,000. Then our second property was a $420,000 property in Adelaide, in one of the worst suburbs in Adelaide, in the country. It's now worth 820 after 4 years. It's 100 grand a year from that one property. And my mindset around it was, if I can build this moat around my business, if my business was to die tomorrow, which it could, I'm good. And think about how many business owners during the C word, the big C, had to shut down their doors. Well, it's like an insurance policy. So a lot of the time when people talk about property, they say things like, I want passive income. I want a specific number. How do you help clients, or how do you empower men or women to build their property goals? Because they often don't know what's possible. Yeah.
So we obviously start that everyone has a bit of a protection mechanism. We have the risk of business and the risk of churning money, and we don't really want to bring risk into some of the other places. We want to provide for our family. We want to make sure we're not taking away from opportunities from the kids or our wife or our partner. So what we need to do is make sure that we understand how the cash flow mechanism is going to work, so that it gets the property out of our back pocket, unless we choose to want to throw a bit more of savings at it and all that stuff to be able to build it quicker and faster. So when I look at a client comes in, we want to know, do you have your emergency buffers in place for your own family? Do you have savings plan to do things? Do we need to go after equity to help give you a cash flow buffer so that you feel comfortable that you've got a few $100 grand sitting in a bank account, or $100 grand, whichever is the comfort mechanism for the person, so that that's sitting there for us to not only do the deposits, but after the purchase, you've got cash flow. That gets that property out of our hair, and we can keep grinding. And we can keep providing. And then it's all about looking at how the borrowing capacity works for getting the next property. And then it's not all just lending as well. You've got to then go, and we need to get the right property, because the wrong property can screw us up as well.
Yeah, a lot of people say that. They're like, what if I mess this up? And it's like, you might. And that's why I think diversification is so important.
That's right.
You've got a client that we're working with at the moment, you and I both. He's an empowered man. He's come to you, and they've put 850 grand of their own money into a mortgage to pay it off. And we've had multiple clients do the same thing. And just for anyone listening at home, so you can understand why I wouldn't do that, not financial advice, just why I wouldn't do that. Let's say your interest rate's 7%, right?
Yep.
Let's say you put 850 grand into that property. So 850 grand times 7%, I think it works out to around 60 grand, 50 something $1,000. So each year you save 50 to 60 grand on interest. Now, if you were to take that 850 grand and buy 4 properties worth 750 grand, right? And you find the right lender, you find the right broker, the right property, you've now got $3 million of property with that 850 grand.
Yeah.
Now, for all our properties, they've gone up 25% a year the last 3 years. Let's be conservative. Let's say you find a property that goes up 15%. So you got $3 million of property. If you've lost me here, I'll explain it. You got $3 million of property. It goes up 15%. That's 450 grand in year number 1. So you've got 450 grand of equity, of uplift, of money that's come to you doing nothing.
That's right.
Versus the 50 you save. So you're now, every year you don't do that. Every year you pay down your mortgage, you're losing 400 grand.
That's right.
And when I explained that to these clients and when they came to you, they were like, oh my God, I never knew that. But they were told, pay down your mortgage, be debt free. Whereas you can actually use debt to build massive amounts of wealth, right?
That's right.
So like, what are those magic numbers when a client comes to you? What are the numbers we want to aim for to create financial freedom?
So when with that particular client and even anyone in property investing is that, we can pay down our principal place of residence, but it doesn't bring us rental income in. It does go up in value, but if we can multiply the properties, what's better than one property is 10 properties.
Yeah.
It may be a different metrics that you use with value of properties or a number of properties, because the more, if you've got 20, 30, 40 properties, you've probably got a headache of how many tenants you got. But
of course,
the metrics that I would say is that when people get a little bit of their aha moment that I need to invest now, and they go, cool, I can actually make a passive income out of this, or I can actually get to retirement, sell these down, or I can actually get to my goal of, I want to take the family on holiday, or I've grown so much in the business and it's going up in value, and I've got this property going up in value, and I can actually then reward myself along the way. People would then say, oh, cool, I need to get a passive income. Mm-hmm. So this passive income thing is, say it's $150,000 a year that you want to have for the rest of your life, and rental income is the magical number that we're going to go after. Mm-hmm. In Australia, most properties will go up by 7%. So let's take a more conservative approach and go to 5% year on year. Mm-hmm. So 5% return is, we need assets with no loan on it. So I'm now doing myself out of a job. So you need me to get the properties, then you need me to get rid of the debt. Mm-hmm. And then you don't need me, right? Mm-hmm. So we get 5% return is $3 million worth of assets at a 5% return is 150 grand, mm-hmm. right? So
and that's rental income you're talking about?
That's rental income, right?
Okay, so you got $3 million of assets, debt-free, that's bringing you in 150 grand a year. So you're not paying any interest, you're not paying any principal.
Yeah.
If you're getting value from this podcast episode, please do me a favor and hit that subscribe button and the bell icon. It allows us to reach more men, to keep more families together, and to give you more value with the guests that we get on board. So please do me a favor, hit subscribe, hit that bell icon so we can give you even more value.
So that's 150 grand, but we all know that we probably need to go more than 3 mil, because 150 grand is not going to pay for the council rates and any repairs that comes along the way.
Yeah.
And you've got to figure out which types of properties you're going to hold for a long time to provide this income. So we probably need about 4 million. So 4 million is going to give us, we can have the 150, and then the balance between the 150 and what we get for the 4 million is going to pay for the council, the repairs, the other things like that. So then we're sitting here, we've got our $4 million property portfolio. We've got no debt on it. We've got 150 grand a year coming in. We've got all our expenses paid on the properties. Now we've got something to think about, right?
Yeah.
Do we need to work? Do we choose to work? Do we go on a holiday? Do we not go on a holiday? Like, now life changes for us, right? Mm. So we might put more focus into the business to build it up, to sell it off, or whatever we need to do. We might we might have sell the business off and be the landlord for the business. Like, there's so many levels of play now that we have. A lot of people, when we get up to the goal of, say, passive income, I can give them a call. Big top portfolios in my customer base will give them a call and they go, mate, I just want to get to 15 mil property. Right now, the goal is game.
Yeah.
It's not, I've made my goal. I just want to play the game, or I've made my goal. Thanks very much. Let's keep going. So with a passive income goal, my numbers, I always go on the conservative. Property's been doing 7% in Australia. I go down to 5%. But then when we break it down, like that 150 grand, we need to get to $3 million. So how do we start when we don't have a property portfolio now?
Yeah. How do you begin?
So we need to get the debt. So if we need $3 million or $4 million of the property and we only have a borrowing capacity of $1 million, it's not, there's a big gap, right? So we've got $1 million. That's only $1 million, for example, 100% lending, not that that's around, but that's only $1 million. We need to get the 4. So how do we do that? And that's when people articulate a goal, or I'm able to extract it out of their head, which is another thing. I'm trying to extract goals out of people's heads every day. Once we know that, passive income would be great. Property with no debt would be great. My own place in the future by using investments would be great. Once I know that, we can then map out our first one. First one may go into your own name. The first one may have to go into a self-managed super fund. The first one may have to go into a trust environment to help us manage your borrowing capacity for the long term. And that's when, okay, we've got $4 million worth of property. We've got $1 million worth of borrowing capacity. I now need to figure out a strategy to replicate that million by 4.
Yeah.
And that's
what most people don't know how to do.
Yeah. And I can only figure that out when people explain their goal.
Yeah. And this is so important for anyone listening, because there's a lot to unpack there. The first step of building financial freedom is to define what financial freedom means to you.
That's right.
So what does your dream life look like? How much does it cost each month and each year to fuel your dream life? I think for most people in this day and age, 150 grand isn't going to get you very far. If you got 3 kids, if you got a family to look after, you live in Sydney or somewhere expensive like that, it's not going to get you very far, but it's a starting point. So what does your dream life look like? And then from there, we get to reverse engineer. How do we achieve that goal through investment? Because for anyone listening at home right now, real deflation, you can Google this, you can argue it. It's around 10%, right? Real inflation. That means every single year, your $1 million is going down by 10%. And because it's exponentially going down and deflating, $1 million in 20 years is worth like 200 grand. Your money is getting burnt to the ground. So if you don't have your foot in the door right now with some sort of investment, you are burning your cash to the ground. Right. We had an event 2 years ago, and one of our buyers agents, Dashdot, who you work closely with, he's helped us buy the 8 properties, as have you. He did a presentation and he offered the opportunity to buy properties. 12 of the men out of 40 bought the properties. All of them have grown not by 7%, not by 5%, by 15 to 20. You can get outsized returns. This year, we're talking more about property. All the people that were at that event, the 28 who didn't buy, like, I should have got in, right? So step 1 is knowing what your goals are. Step 2 is knowing structures. Can you explain what that means? Because when I came to you, my borrowing capacity was 1.5 mil. Within a few months, you got it to 6.5 mil. It blew my mind. I didn't understand these numbers. For anyone listening at home, they might go, this makes no sense to me. Rosie and I were paying ourselves minimum wage for quite a while, but we used equity, we used the right structures, and now we have 8 properties worth $8 million. Can you explain how the listener at home can implement this?
So some people would think that's a bit weird going, well, you've got $1.5 million and now you've got $6 million worth of debt. How the hell has he done it? Has he gone to the black market, put his balaclava on, gone to the bank, seen what we can get out of him? Not that anyone carries cash anymore, which is a really interesting thing about what you're saying about currency deflation and the need, absolute paramount, 100% need to invest now. If you're not doing it, do it. It's with the structures, there's 3 areas of investment. Your own name, which everyone knows. It's where you put your owner occupied mortgage. If you're going down the path, it's where most people put their investment properties and they forget what else they can do. A lot of popularity, like years ago, structures around self-managed super funds and discretionary or unit trusts with a corporate trustee, fancy words that we bring out, weren't really talked about. And as the interest rate went up after COVID or after now, is everyone they're getting capped out on their borrowing capacity. So they're looking for ways that they can go for structures and things like that. So I categorize it into 3 things. You can invest in your own name. You can invest in superannuation, even though it's a dirty word sometimes for self-employed. And you can invest in corporate entities. And the equations change how you're going to look at how the borrowing capacity. So your own name has a borrowing capacity and your self-managed super fund has a separate borrowing capacity, and none of the two meet.
So you could, just to clarify in plain English,
yep.
Most people invest in property in their own name and
yep.
then they instantly get capped out and now
That's
they're
right.
stuck. They can't move. So,
yep.
so they're stuck. There's another entity, which is your self-managed super or your super, sorry.
Yep.
And that can be invested in and it has no bearing on what's happening
Correct.
Personally. So you can basically double up in a way.
Correct.
Amazing. Okay.
Yeah.
Yeah.
And that's really the 2 separated places. Okay. Self-managed super fund, highly regulated, and we only submit 11.5% of our wage as we declare a wage into our super. So it's a lot less income, and it relies heavily on the rental income to get there. So it is a bit less than your own name. Your own name has gross income and all that nice stuff that comes into it. The other area is your discretionary trusts and things. So. And this is where the collaboration between accounting and the buyer's agent comes in, because we want to get the right property and we want to have the structures all set up correctly. And then we need the lending. And a lot of people think if we go, we know, most people know self-managed super funds have a higher rate of interest and our own name has a lower rate of interest. And then when we talk about trusts and structures, they think the interest rate is going to be the same as the self-managed super fund, but it's not. And we still have all the options that we have. You can have an offset account, you can have equity, we can construct, we can sell. Everywhere we can sell our properties or buy more. So when we're doing the trust thing, the equation changes. It's not separate anymore like super in your own name. It's actually your own personal borrowing capacity plus the trust. Mm-hmm. And if we have too much in our own name, it's going to screw us for standard residential properties to buy stuff in a trust. So sometimes when people come to us with too many properties, it may have to be unloaded and then load back up in the right area.
Yeah.
Or they've got something in their own name, which is not a bad thing. We want something in super and we want something in our own name and we want something in trust. We just got to manage the equation. And that's where a strategic mortgage broker comes into that piece of the puzzle.
It's amazing that you say that, because that's the name of your
business. That's the name of my business.
But it makes a lot of sense.
That is.
Because I was going to speak into teams. So for anyone listening right now, you either have no properties or you have properties, and all of this is relevant despite which bucket you fall into. So step 1 is having the right goals.
That's right.
Most property investors just go into the wild, wild west. They buy in their local suburb. They don't care about yields. They don't understand equity growth. They just buy what they think they should buy. There's no expert advice. Then they don't know what their goals are. So if your goal is financial freedom, but you're living in your own place of residence and paying down the mortgage, it's very unlikely you're going to achieve financial freedom. So we don't actually define these things. The second thing is we don't have the right structures. Mm-hmm. So most of us put the property all in one place. We get capped out either on borrowing capacity or our deposits, right? Step 3 that I'm seeing here is we don't have the right team, right? So
team is very important.
Yeah, well, when I came to you, and for anyone listening at home, I thought I was going to have to work for the rest of my life because I didn't understand any of what you're talking about right now. Maybe a listener's going, this all sounds great, but this is a lot, right? And for me, what's helped me the most is having the right team, having an accountant that works with you, having you getting my borrowing capacity up, and then having buyer's agents, which are people that I pay because I'm a busy business owner who go and find the right property in the right place at the right time.
Yeah.
And one thing that you taught me that many listeners might not know, if you're the sole director of a business and that business is profitable, the bank or the borrower or the lender will look at your business income or profit, combine it with your personal income and profit, and now the bank thinks that you're making way more money. Can you explain that to me?
So it's like if you're a sole person running your business and it's a company and you made profit, and you've also done the right thing by taking a bit of wages because you've got to live, right? Like you can't not take anything.
Yeah.
Sometimes you get funky with distributions and things, but we've got some profit in our business and we've got an income. The really cool thing is that you're just one person going to the bank. Let's just say you are a single guy and we're going to the bank and we've got our company and we've got our income. the really cool thing is it's both. It's like you've taken two people where you're one person to the bank. So I try to put it, you got one person and you got a person. You bring in a mate along that doesn't talk, eat, drink. Oh, well, takes a lot of your time and effort, right? It's your business, but you're taking your mate along that's got profit that adds to your income. So if you've got 200 grand of profit in your business or a million, wherever it goes, but let's use 200 grand in your net profit in your business. You've paid yourself 150 grand, 100 grand, wherever that is. We'll go with 100 grand because most accountants will probably want to bring me down sometimes on that. Yep. So we've got 200 of net profit, 100 grand in your own individual tax return. We're not doing your borrowing capacity of 100 grand. We're doing it of 300 grand.
Which is 3 times more.
That's right.
Now, what does that equal in terms of what you could borrow roughly? So you're on 100 grand, you're capped out, you can't buy any property.
Yep.
What are you at compared to 300 grand?
Yeah, so if you've got a couple with 3 kids and you're earning anywhere between 300, 350 grand a year, probably get about 2 mil.
And then that includes the business. Now, if we didn't include the business and we weren't aware of that and we went to a regular broker, we'd be sitting at 2 mil divided by 3?
Yeah, 100 grand for a single person just renting, maybe between $500,000 and $1 million.
Okay, so let's just do some quick math for the listener. Let's say you have the cash deposit, you buy a property for $500,000, it goes up by 10% for math's sake.
Yep.
You've made 50 grand in that year.
Yep.
Okay. Or you leverage debt, which is scary and risky for most people. And you use the right broker and the right team. And instead of buying a $500,000 property, you buy a $2 million property or 3 properties worth 2 mil. And that goes up by 10%. So now you've made 200 grand. Mm-hmm. So the difference between the two is 50 grand to 200 grand.
50, yeah.
It's $150,000. And all that changed was you took on more debt and you borrowed more money.
Yeah.
So why wouldn't anyone just do that option? Why don't we all just do that?
Well, it's you need the team around you. As you said, if you don't have the team around you, who maybe no one's thought about, I actually need to have 20 or 30 grand sitting there for this type of property, or 10 grand for this type of property to cover any of the vacancy times or a mortgage payment. Or I know of half a dozen investors that have settled recently and they've been fighting with their property manager to get the rent out of them, and they've had the mortgage payment come out before they've even got the rent on once they've bought it.
Yeah.
So if you're just buying properties without the little bit of preparation, like not just what your borrowing capacity is, not just getting a pre-approval, but do you actually thought about how much money I'm going to have after this purchase? Because if you have money after this purchase, you're going to hold on to this property so much more longer and feel more comfortable if a mortgage payment comes out and I didn't get my rent in. Mm-hmm. So most people, if you go out and you just buy a property and you haven't thought about the cash flows, and the cash flows are critical, especially if you want to do a big portfolio, that's where it screws up. That's where people are not getting to them. We love property in Australia, but when we have property, everyone demonizes us, right? But we love property. We love buying our own house. Everyone congratulates us, get their own house. But it's all about the cash flows. If you can manage the cash flows, anyone can do property. It doesn't matter if you've got zero now and oodles of equity in your own place, or an ability to earn, save a few grand a month. There is a period in time that you're going to get property. You can get it.
I love that. And I want to dive into those numbers. And I also want to dive into this tall poppy and just the hatred we have for people who build success. I'll talk about that really quickly. I have been grinding in my business for 8 years. I missed the first 2 years of my daughter's life. I took on so much risk. I hired 30 people and fed all their families. I've had people be poached, and I'm not here complaining, but it's been fucking hard. And now I have 8 properties, and I didn't even think this was possible, right? But it's required so much blood, sweat, and tears. And a lot of people listening are like, fuck that guy. He's using debt. He's screwing us over. He's driving up property prices. But they would all like to be in that position. And it's this weird thing that happens in Australia specifically and New Zealand, where we demonize success and we demonize wealth building, even though there's so much risk involved with that. What do you think that is? And then we'll get into some numbers and what people actually need to get started. But what's causing this just horrible hatred towards success in Australia with property?
It's interesting because as I've scaled my team, I've done advertising, and I continue to advertise because I want to help more people do this. And it's really interesting watching the Facebook comments on my ads going, if you've got the 2 properties, you need to get to the next one, right? If you can't get to the next one, there's something wrong. We need to understand the numbers and do stuff. The people that comment on that are all the haters.
Yeah.
It's like, no, you're going against the bank's rules and you're going about this wrong way. Oh, these renters, all the stuff that you're talking about that gets tall poppy syndrome is all the comments I get. And I'm just going, thank goodness for you guys. Comment as much as you like because you bring my ads down, right?
Yeah.
And it spreads the message. The people that are responding to my ad are the ones that you would consider if you were the person that was thinking tall poppy. They're the ones that are needing the genuine help. And they're just so coming across going, so great that someone actually understands me. So great that someone can actually think about this strategically for people to get bigger. Just don't tell anyone.
Well, this is the thing. I think it's because hurt people hurt people. And I just looked up the stats here. I don't know if this is true. This is just on Google from what I looked up. There are only 45,162 people with 4 properties in Australia. That's 0.19%. There are only 18,863 people with 5 properties, 0.07%. This is wild, absolutely wild. And with 6 properties, 19,000. So, Rosie and I hit that target 3 years ago. And I think what most Aussies don't understand is it's not hard to get to 4 properties.
No, it's not hard.
It's not hard. And you don't have to demonize it. Every single piece of energy you have hating on someone who's buying properties, those people, myself and Rosie, we're taking all the risk. We're housing people. We're doing the repairs. And you can do that too. So if you're a listener at home right now, you've got your goals, you've got your structures in place with the right strategic broker, you got the right team. What do you need to get started? What are the numbers or the minimums somebody listening can go, I can do that? What do we get to aim for?
So two categories: people that need savings to get started, and people that may have their own home with a bit of equity. It's usually the 2 categories I see. And we can talk about how the own home is actually something that will detract your borrowing capacity. So when you don't have, you're trying to get to a savings goal. Most people don't know what that is, and that's actually the driver. That's like if I give a business owner a goal, what happens? They think they can get the goal in 12 months, but they do it in 3.
Yeah,
it's fascinating with business owners. You say, I need 100 grand. Cool. Give me a call. Give me a call in 12 months. And I don't know, mate. I'm going to give you a call in a month and a half just to figure out where you're at.
Yeah.
So the goal, typically 100 grand will give us the keys to the gate.
Okay.
That will get us into that $500,000 area. So most properties that I'm seeing, I talk to a lot of buyers agents, right? So some people that specialize in owner occupiers, people that specialize in location, people that go countrywide, people that want to all that stuff. So anywhere between that 450 to 800 grand mark, there's a bunch load of properties out there for entry level area. So $500,000, 100 grand, we're probably going to be borrowing 90% of the property's value. If we're meeting all the income benchmarks, we can probably even go to some of the major banks now that are throwing 95% at these things. So what we want to do, that's probably the keys to the gate.
Okay.
And then we need to have a savings plan, and we need to think about what we're going to be doing to hold the property for longer, because property with the interest rate where it is, you need to be actually saving and paying for stuff. The rent's not going to, the rent will maybe cover the mortgage for the right property, but you still got your council rates and things like that. You just got to think of that as savings, not as cost. The people with your owner occupied mortgage that has a bit of equity, we probably go back to the banks, and we'll pull out, not only if you don't have any savings and you've got a savings rate, we can probably pull out more equity than we need. We pull out the costs and the deposit for the property, plus we'll pull out some equity for cash flow for you to feel more safe and protected around what's going on with property.
Yeah.
So then we pull that out, and then we will also get a pre-approval on the next property. So if it's a couple $100,000, that might give us more flexible. So we might put 50 grand away, 150 grand to the property, still between that $500,000-$600,000 mark if we're looking at the lower end, or if we got oodles more equity. And the advice for self-employed people, if you're going to get access to equity, we may as well take it whether we think about it or not, because you never know what's around the corner, right?
Yeah.
Get out of jail free card sometimes, but we can get out the equity we need for property. We get out the buffer, or if we've got the buffer, we can change around the numbers. So that's sort of 100 grand. If you can get to 100 grand, it's where we can start, but it's not the end of the story. We've been doing a bunch load of properties recently for first-time investors, first-home buyers and first-time investors. Similar mentality, I find. But if you we've done property investors with no deposit. We've got 20, 21, 22-year-olds going into property now, and mum and dad have been like you, Tony, where you've built up your own portfolio and you want to help with the legacy goal. That's another one. Legacy goal. How can I help my kids get into property? Well, this is a nice way. If you've invested in your own name, you can actually help with a family guarantee or something like that to reduce the amount of money they need to get into property. So we've done probably like $300,000-$400,000 property for one of the clients that had 40 grand only. She kept the 40 grand as savings buffer, and mum helped because she knew that she was never going to get into the Sydney market. She had to invest.
If you want to actually take this framework that I shared and apply it to your life, it's part of our Empowered Man Armory and our app that we've spent almost 250 grand on. If you want access to a powerful system where you can use this reframe system I just shared with you every single day, then find me on Instagram at Tony Empowered Man, TonyEmpowedMan. I'll put the link down below as well. Send me a DM saying reframe, and I'll give you this exact framework as well as early access to the Empowered Man app when it launches. I think that's a point as well. I want to jump in there because somebody listening to this right now might go, 100 grand, are you fucking kidding me?
Absolutely.
But you just alluded to the fact that you can buy a $300,000 property and you need quite a bit less for that, right? So let's say you buy a $300,000 property. How much would you need for that?
Yeah, so about 5%. So that's probably without any costs or trying to find the property, because 300 grand properties, I can tell you're probably going to need a professional to find the right one.
Of course, but let's just say you find the right property. How much would you need?
Probably about, 15. So 30 grand's 10%, 15 grand's 5%. Maybe you probably need about 30 grand.
Okay, awesome. And I think that's within a lot of people's means. And if it's not, you get to find out how to make it in your means. Because the second property we bought in Australia was 360 grand.
There you go.
We bought it through a buyer's agent. It's now worth 580. We bought it 4 years ago. And it's also a cash flowing property that's paying us a huge amount of rent each week. It's cash flow positive. So it's paying for itself. So it's a very, very good buy. And I want to just break down these numbers. So you have 100 grand or 50 grand, right? You just buy a smaller property. And that 100 grand can buy you a $500,000 property, right? Now, let's say you do have the 100 grand. You borrow at 90%. So you got 450 grand of debt, correct? Roughly.
Yep.
Okay. Let's say that property goes up 10%. I know we can be conservative. I like to make it simple math.
Cool.
That $500,000 property goes up to 550 grand.
Yep.
Makes sense? So you put in 100 grand of cash for everything, all inclusive, stamp duty, all that sort of stuff, whatever you have to pay. 500 grand turns into 550. So now you've got an uplift of 50 grand. So in year number 2 or year number 3, you can use that equity, that 50 grand, and now you don't need to save 100 grand for property number 2.
Correct.
You only need to save 50 grand, correct?
That's right.
You pull that equity back out. And then in property number 3, you've got 2 properties that are going up, and now you only have to put in. Does that make sense?
Yeah.
It's this infinite glitch.
So you've got this thing called time, which is something that people feel like they don't have time to do anything, and you need to give property time. So what's easier to do? Save a deposit for a house or earn more money?
I would say earn more money.
Earn more money, right. So if you reduce the hurdle down to, say, the $300,000 property, we reduce the deposit and the hurdle becomes less to get there. Once you get in there and the equity goes up, the thing we need to access equity is income. So it becomes easier. It's your day-to-day. So for every guy out there, income becomes easier to get. Equity goes up. So income, equity to leverage up. So it's like this stepping stone. Hurdle for the first one, income for the next one, get the borrowing, get more income. We don't have to go too hard on the income because we can structure things out, as we mentioned before.
Yeah.
But it's all about that. And then over time, we might even do other variations to put property as well with sell and stuff like that. But the time factor is the key here. Most of the time, when I boil it all down, what are the problems with property investment? One is, what are you willing to make a decision on? And the other one's deposit creation. There's only two problems to property investments: what's between your ears and deposit creation.
You mean having the money to put down to get the loans?
That's right.
But is there a third problem, which is borrowing capacity, or is that fixed with the right structure?
Well, my statement is, I firmly believe there is no such thing as a borrowing capacity cap if you think about it correctly.
Wow. Okay, so it's infinite.
It is infinite. Okay. I say manage the borrowing capacity because of the tall poppy syndrome out there, right?
I like the word infinite, but you can use your words.
So we might, if you're thinking like that stepping stone, we get the hurdle for the property and we get more income, we get more debt, we get more income, we get more debt, we get more income. How far do you want to go?
I want to go to the moon. But it's a game for me.
But do you really want to be hammering yourself to get $2, $3, $4 million worth of net profit per year out of it? You probably want to manage that a little bit more.
Of course, I want to have a lifestyle as well. But I also realize that you can, on a lower income, build financial freedom in 3 to 10 years quite easily if you have the right structure.
That's it. And even if you simplify it down, I've done some linear numbers of just standard properties over a 15-year period. You can get to freedom as well.
Yeah.
It's just that you can shortcut it by getting the right advice, the right team around you.
Yeah.
And with that whole borrowing capacity thing, if you like one of the things that so I was an example of buying an owner-occupied property, and I know that it hampers my borrowing capacity a little bit at the moment. But my other goals are business, right? Mm-hmm. And I'm also 2 blocks away from school for my kids, and it's a few $100s less a week than renting in the same area. So even though I might have gone down the owner-occupied route, I still can invest. I just have a bit of joy in my life related to kids can walk to school, come home. Yeah, it'll have the same thing. But the other decisions, like if I got rid of that property, I would have capital. Mm-hmm. I would have rent instead of a mortgage. And then I would have the ability to accelerate my borrowing capacity. So time and choice around property portfolio development gets in there. And we don't want you to go, we don't want your broker to come back to you and say, you need $2 million worth of income per year now. Yeah. We want to make sure that you understand your cash flows. And as a business owner, or even not a business owner, you can get to understand cash flows pretty quickly, especially on property. And then we can understand, where does your profit need to be in your business over time. We can start talking to your accountant and things, which is a really key factor from my point of view, for myself and my team, is to talk to the accountants and things around this time of year. It's just to what if you needed 10 grand extra in your business between now and the end of the financial year to achieve your property goal? I don't know any
money. If you know what the target is, you make the money. Right. Even if you're not a business owner, full disclosure, my wife and I aren't lucky, but we are blessed. And let me explain what I mean. I bought this property for 188 grand. And that was, I think, 6 or 7 years ago. And then I pulled out 150 grand. So if I hadn't made that purchase, we would not have this property journey. Right. And every stepping stone has taken us to the next level. We then used that to buy 3 more with the buyer's agent. And then we chilled for 4 years. We didn't buy anything else. We were stuck and capped. Then I met you, right? And you helped me raise my borrowing capacity. But I was capped. I didn't have enough money because I was paying Rosie and I minimum wage. I want everyone listening to this not to think I'm some rich guy. I was broke. I was almost bankrupt 3 years ago. So I went to my parents. I went to my mother and stepfather. I went to my grandparents and I said, I would like to buy more property. I'm capped out. Again, I pulled out equity. So I took on more risk. I took on more debt. And then I borrowed, I think it was 180 grand from my grandparents and parents. And that was a lot of money. But I knew the cost of my pride of not wanting to borrow and not wanting to take on more debt would handicap me. So I took the risk. It took us 3 years to pay it back. We didn't save any money, but now we're in this position where we have 8 mil of property, right? So I think to anyone listening, if you don't have the 100 grand, how can you get resourceful? I hear from clients all the time, I could get the money from my parents, but I don't want to. fuck that. Like, get the money, right? Invest, because you're handicapping yourself. One thing that comes up for me around the strategy is, let's say you're borrowing more money, your property portfolio is going up. What are the risks in terms of servicing the loans? And like, do you do interest only? What's the structures to build? Let's say your goal is build as much wealth as possible. What are the risks with servicing these loans, interest, etc.?
So we can take it simply. Principal and interest only is usually where the conversation starts on this one. If we went back a few years, interest only was costing way too much compared to principal interest. But right now, interest only is on par. So the interest rate expenses is owner occupied interest only is up here. Investor interest only is down here. Investor principal and interest and owner occupied principal and interest. That's sort of the scale of expense.
So the higher, for anyone who's not watching or just listening, at the top of most. Can you do that again?
Owner occupied interest only is up here.
Because
no one wants.
Interest? Okay.
Why would you pay interest only on non-deductible debt, right? And the banks know it, the regulators know it, and that's why it's priced up here. But it's still an option.
You mean it's the most
expensive? Okay, Then interest only investors underneath it. Okay. So getting interest only on investment property is cheaper than getting interest only on your owner occupied for a reason. And then it's principal and interest investor is about the same, similar, not too far off, except for some non-banks. And then your owner occupied principal and interest obviously is the lowest, which is where all the encouragement and incentives comes into.
Pay off your own mortgage, and that's why it's incentivized. It's almost like subconsciously, this is a good thing. But the banks are making the money, not you.
Correct. So that's the cost there. So we do it's a lot of interest only at the moment, because the only thing you can put in your tax returns is the interest. The principal component you pay off is coming out of your own pocket.
And that money could be used to invest in other assets.
And it can be used to build up your offset to go for another asset, or can be built up to get rid of your owner occupied if it's still there. So that's sort of that strategy there. And then we just place the debt in the right spot strategically for you to keep going.
So what's the risks of that? Because I know for Rosie and I have, I think it's 6 mil of debt, and at 7%, that is a lot of money coming out. But what people don't see is some of our properties pay for themselves with rent, others don't. So I think we have to put in about $1,500 a week into servicing those loans, which sounds like a lot, right? 75 grand a year.
Investment plan, right?
Well, this is my logic, is if we put in 75 grand a year to to just keep those properties, we're not paying shit, but they go up by 700 grand a year.
That's right.
I've put in 75, I'm making 700. That is a trade I'd make any day.
That's right. And then what's the risk with interest only is that we get 5 years initially, and then we can go back to the same bank or go to another bank and get another 5 years or 10 years or wherever the bank's policy is. There is at some point in the future, not usually in the accumulation or the younger years of life, which is obviously a choice of how do you figure out your younger years of life, or it's usually how early do I want to retire. There's going to be a point you have to repay the debt. We can go endless recycling of refinances and stuff. There is going to be a point that you have to retire the debt, but do you have to do it now? And is it in line with your goals?
Okay. So it's basically knowing what your goals are. Like for me, because I understand this, the goal is build as much wealth, capital growth as possible, not rental income. Because if I'm making 150 grand a year in rental income, that's not going to give me a great life. Whereas if I'm making $1 million a year of capital growth for 10 years, and then I sell everything, and even if I pay half in interest, I've got $5 million just sitting there, and I put that into a 10% return, that's 500 grand a year. Does that make sense? As opposed to the 150 grand.
The thing around risk with debt then. So the interest, we're taking on so much debt here. Are we going to feel buried? Well, we've got to think about it slightly differently with investment property and property investors, is that we need to think about what the cash flows are versus the amount of debt we have.
What do you mean by that?
Yeah. So the amount of debt we have may keep you up at night, but we shouldn't take on that much debt if that's going to keep you up at night. But if let's say it was going to keep you up at night, the $2 million worth of debt or the repayment of $2,000 a month, $3,000 a month.
Such a difference when you frame it that way. Yeah.
And then in that $2,000 or $3,000 a month, you might have rental income of $2,000 or $3,000 a month, right? So then you're going, cool, well, I only have to cover the maintenance, water, rates, all that sort of stuff on the side. Cool. So the mortgage is actually just about covered by the rent. So now we've gone, yep, we're going to stay up at night, all night, $2 million, $4 million worth of debt. And now we're thinking the monthly repayment. And then when you look at it from even the credit reporting bodies, so when we go for a loan, they're going to check your credit file. The people that have the higher credit files, or the people that have their credit score go up, are the people that take on secured debt with real estate.
So you have more debt, you have better credit score.
More debt, more credit score for a specific debt, the real estate mortgage. That's what puts your score up. You know what pulls your score down?
What?
Credit cards, personal loans, car loans, payday lenders, all that stuff is going to bring your score down. So when you apply for that debt, score comes down. When you apply for the real estate debt, score goes up.
Amazing. So let's say you have got $2 or $4 million of debt. You're saying instead of going, oh my God, I've got $4 million of debt, so risky, you go, that $4 million of debt is simply $2 or $4 grand or $6 grand a month, which is, $500 to $1,000 to $1,500 a week, which I can afford. Instead of saving, I'm going to spend that money. But that 2 or 4 mil is going to make me each year 200 grand, 400 grand, etc. So that's a really good reframe for anyone listening, because that specific client we were talking about earlier, their mindset was like, oh, what if I take on too much debt? They're making a lot of money between their business and personal income, and they've got $800 grand of equity. And the frame was, well, what if I take on too much debt? Okay, that debt is $4 grand a month. It's going to make you 400 grand a year. Now, do you want to do the deal? Yes, right? Yeah. And I think we overcomplicate these numbers because we don't understand them, right? I think the key lesson for anyone listening is debt doesn't have to be bad. Leveraged property debt can be one of the fastest ways to build wealth in Australia. You leverage the bank's money, you leverage debt to make way more money and take on what you feel comfortable taking on.
That's a good mate of ours that talked about how much our currency is deflating per year. For us to frame up why the interest rate doesn't matter for property investors, right? So he was saying that if we're not getting a return on investment, this is Goose from Dashdot, if we're not getting a return on investment of more than 10% per year, we're losing money. So having money at the bank, having money in shares, having money in stuff that's not giving us more than 10% a year, we're going backwards. It doesn't matter how much. Well, it may matter how much we earn if we're earning millions of dollars, but if we're not getting that extra return on top, we're not making any money. So then it comes into, what if we had an interest rate of 6%? What if we had an interest rate of 8%? Now, if we're borrowing money today at 8%, we're 2% under the devaluing of money in the future. So we're borrowing money today to invest in property that's going to appreciate in the future at less than what our money is decreasing right now. So people get stuck on the interest rate all the time. And I love the interest rate going down because we make more money. Our rents stay up. You're happy with interest rate reduction. I'm happy with interest rate reduction. Absolutely. Let's bring on a couple more. We just are going to get our cash flows better. But people need to think about it's about the cash flow day to day, not necessarily about the interest rate. Because we when you come into our business, we're working on what are your circumstances, what are the banks and structures going to suit you. There's usually 2 or 3 lenders or more that we want to get the right rate from, but it may not be the low rate. And we get two big examples. One client, he called me up the other day. He goes, I want to refinance my mortgages. I've got my owner occupied at 5.85, which would be pretty sharp in the current market. And I've got my investor at 6.34 it was, which is pretty sharp today, being that we should date it. It's around, what are we, April? April 2025 for the interest rate benchmark. I could save him 0.15 off his rates. He goes, just refinance me for 12 months and we'll be good. And I said, you're not going to save any money. If I refinance you, we're going to save maybe 0.15. And we kept talking. And then he goes, oh, I want to invest with my daughter and I want to invest more money. I want to invest more property. And at the end, he went, I don't really need to save the interest. I really need to talk about investing in property. Because if I'm going to save 0.15 here on a percent of rate and we're rate shopping, what if we didn't rate shop and we went after a property that is like some in your portfolio, which went up 200, 300 grand in 12 months, 0.15 doesn't matter anymore.
0.15 is nothing. It's nothing.
That's right.
And this is what we again, like we don't understand these things in property. We just have these preconceived beliefs whenever questioning, buy your own home, pay down your mortgage, only buy in the suburbs you want to live in. All of our properties, I've never seen in person, ever.
I've never seen
them.
Yeah.
And they all look like crack dens. And I would never live in them. And
Yeah.
they're disgusting. And they pay the bills and they grow in value. So I think we have all this common misconception going on. And that's why it's so important to have expert help. You know, if you don't know how to train at the gym, you get a personal trainer, right? You don't just
absolutely.
go and freestyle it and do some stupid exercises. Second tier lenders versus different banks. So, you know, something I always thought when it came to property investing, another preconceived belief was I need to go with ANZ, NAB, all these big Australian banks. Now we're talking about all these places I've never heard before, Resimac and Peppers and all this stuff. And the interest rate's only slightly higher. And they're willing to just throw money at a lot of people. So talk to me about second tier lenders. Why do people fear them? And should we have all our loans in different banks?
Yeah. So I don't think you should have loans in all one bank.
Why not?
We can use that for a period of time to grow portfolios, and there's reasons why. But then what happens is the banking calculators change. So having debt at other banks will be able to get more money from this particular bank. So if we have debt at CBA and debt at ANZ and we go to one of these non-banks, they're going to consider that debt less risk and give you more money. If we didn't go to CBA and ANZ and we went to the non-bank, they're going to get us less money than if we had the debt at the other banks. So it sounds like crazy what the hell's going on. I would say bank serviceability calculators are a little bit of magic hoo-ha crap going on, but you've got to understand, right? Yeah. It's all made up rules. Yeah. And they're Excel spreadsheets. So someone's very creative in the back end of those things. So first tier, second tier, third tier lending, I don't really like those language because I can go to someone like a Resimac, for example, and I can get you rates that are equivalent to CBA. I can, if there's something wrong with something, short-term ABN, short-term self-employed, you must need to get some lending to do something. They do that type of lending as well, which could be considered second or third tier lending. And then they do the third tier stuff with credit problems. Some of the banks will do discharge bankruptcy and a few other things for solution-based lending because you might have had a life event or a catastrophe with things. So they have that. But then when you talk about sort of the Pepper and the Resimax and some of those people, other than say some of the big banks like the bigger non-banks like Latrobe, where they have their own mortgage fund, which a lot of financial planners will invest into sometimes. If we look at the Peppers and the Resimax and some of those areas, guess where they're funded by?
The big banks?
NAB, CBA, ANZ. So the third tier lenders are there for a purpose. But we can also make them look like a big bank for you as cost. So CBA, ANZ, NAB will judge your new money. If you're going to pay 6%, you have to jump over the hurdle of 9%, which is 3% higher, even though we're in a downward interest rate cycle. Whereas Resimac and Liberty and some of those other banks may only need you to jump over a hurdle instead of 9%, 8%, instead of 8%, 7%, and in some cases, actual rate.
That's fascinating.
So it changes. I presented recently on a case study of a single guy, 180 grand of income, and at Macquarie it was failing. At CBA it passed at $190. Yeah. And at Resimac passed by $14,000 for the same set of data put in for the same outcome.
When you say it passed, you mean this bank here, which is the big bank, not willing to lend you money. Right. You're not eligible. You go to two other banks. They go, here's the money, go buy a property.
That's right.
And this is why it's so important not to go to your ANZ broker. If any brokers are listening who work for the banks, sorry, but fuck you guys. Because this is the thing. We go to the broker at the bank. No, go to an actual broker who's not affiliated with anyone who wants to get you the best deal. Yeah.
And that's where we got one saying no, one saying yes for a little bit, and one saying miles ahead. We're going to go to the one that's restrictive first to the one that's more lenient. So we do that. So the common thing that brokers do is that they go for the most restrictive to the most lenient. What we do for a strategy, we go to the restrictive, we go to the structures to keep your lending lower on the cost because we can still go to the more restrictive lenders. And then as we go really hard at property investing, we may differentiate between getting the good the more restrictive lenders, the more lenient lenders, and balancing that out all the time. We can do it wrong. I've got a client at the moment. We're doing some valuations. We're trying to get his portfolio down. He bought all the properties in his own name. He bought the last property with Liberty. Liberty charged him 8.5% current day terms on his rate. He got the loan, but his cash flow is now screwed. We're now trying to, whether he moves into the house to reduce the mortgage, whether we can reduce the rates, whether he needs to sell a property, getting some accounting advice. So it's all backwards. They've got the property portfolio. Now they've come for help.
Yeah.
So now we're doing the big surgery. It's a bit like healthcare, right? So we got the property coming in. Now we have to go emergency surgery, resuscitate this whole thing, versus someone that comes through the nutritional route or the going to the gym route. We can actually map things out better so that we don't need to go to surgery.
And this is why it's so important, yet again, to have a solid plan. Do not freestyle this. People always say, I'm taking on too much debt or it's risky. What's risky is doing it without a plan. You remove a lot of risk when you have clarity. You really do. And you look at the worst case scenario and you can see it clearly and know it's not that bad. Whereas a lot of people you deal with, and same in my world, they come to you when the worst case scenario is hit. What's the example of the best success story you have? I know you've got a competitor. We won't name his name. He's a guy that I compete with.
You're competing with him.
Yeah, I compete and I can't catch up. But so Rosie and I went from, one property to 8, over the course of the last 4 years. It's jumped from about 1.5 million to 8 million. And we weren't making a huge amount of money. I'd say it's a pretty good success story. But what have you seen as the average Joe who's come to you, who's built a portfolio, and then people like the guy that I know, I'm talking about? Like, what are you seeing in terms of the top line versus the average Joe? What's possible in terms of property?
Yeah, so we've got multiple people that have similar portfolios to yourself through to double.
Okay.
And what we see at the top end to bring tips and tricks back down to the bottom end is really what we've been talking about. Goals, talking to a broker, getting a good team around you.
Yeah.
Because that'll fill in the detail. That's the high level. That fills in the detail. What we see if we pull the curtains back from their property portfolio is that they're investing in all 3 spaces. Their own self, as in borrowing. You should always invest in yourself as what's in your here, right? Yeah. They're investing in their own name. They're investing in trusts.
Yeah.
They're using selling as a technique to help build capital and build buffers and re-diversify and adjust.
Yeah.
And they're adding time in. So when we're looking at one of the big portfolios I looked at, I know what their income was back in 2019 when they came to me, and I know what their income is now. And over the time, we've just been plugging in the properties, and their income is going up at the same time. So we're able to do something with when they start, and then we're just understanding what they're doing all the way so that we can just adjust and tailor and get more properties along the way.
So give me numbers. Like, what does that mean numbers wise? They come to you, they've got no properties, they buy their first property, and then 5 years later, where are they sitting? Like,
So our colleague that we're talking about, we're sitting at a business turnover of a few $100,000 and some profit, and we're going out to get the first property.
Yep.
We can do that. We've done that with leverage, and then we've bought some properties.
Yep.
Then the income goes up.
Yep. So the business income goes up. So now I can borrow more, and I've also got this property that's going up in value.
Yep. So we then can go to equity, or we can go to cash.
Yep.
Depending on how the motivation and structure behind things are.
Yep.
And then we're getting more property. But now we're not just doing one. We're doing the breeding style. We've gone from 1. Now we're getting 2.
At the same time. So you go from 1 property to 3 properties. And the first is the hardest, right?
That's right.
So we go from 1 to 3, then what happens?
Yeah. So then we're now before we get those next properties, we're structuring out some structures.
So now you're putting these properties into different places so that you can keep borrowing without getting capped.
That's right. And then income with our income's going up again. So now we're going, okay, well, do we have the right properties or do we not? Then we're going to buy more properties. And then we took the adventure of buying 4 at once.
Which is 0.0 or 1.16% of people only ever get to 4 in Australia. You bought 4 at once.
And then over the time too, like between 2020 and now, we're consolidating. We're making what loans we bought the properties with may not be the loans forever. We're got some sales down. We've got some use of offset accounts and use of structures and use of equity and all this stuff coming into it to achieve the goal.
Yeah. So for anyone at home who doesn't understand any of those terms, that person, or let's say just person A, they come to you, they're on 200 grand a year, they buy their first property. How long has the journey been for this person, and where are they at now? If they don't mind sharing, like what's possible?
5 years, 9 million.
5 years, 9 million on a 200K income.
The income changed.
Of course. Yeah. But I just want people listening to really hear that. I can't afford it. It's too hard. I don't have the money. Can you find a way to make $200,000 in your business or career, or a combination of the two? Can you find the right goals, structures, team that has taken someone from 200 grand? I know these are just random numbers, 200 grand to 9 million. Yes.
Yes.
Now let's just halve it. Let's say you're on 100 grand, 4.5 million.
Oh, that's pretty good.
That's phenomenal. It's phenomenal.
The worst thing is doing nothing.
Exactly. And I really want to drive this point home, is like, if you're sitting here going, yeah, but I can't, just fucking challenge that mindset, because the fear and the uncertainty and the lack of clarity that you have around property, investing, trusts, what you're talking about, all these things, it's too much for me to understand. Well, start learning about it. Start diving into it, because I'll tell you right now, when I'm not in my business, guess what I'm doing? I'm listening to guys like you. I'm listening to podcasts about property. I'm hiring property mentors. I've spent hundreds of thousands of dollars on mentors and coaches. Find a team that will support you. At Empowered Man, our company that helps men with their relationships, their business, their profit, we actually send guys to you, right? Yep. And these guys are using a team and an expert to help them grow. But I just really want to drive that point home, like 200 grand to 9 million in 5 years. Absolutely wild what's possible.
It is. And it's just about starting.
Yeah.
And that's the key. If we can start, we don't know what's possible. Like, I've seen other people outside the area. One of my property mentors has got 25 properties, but it didn't happen overnight.
No.
Right. So, and what do you see your business being in 5 years' time? We should be also thinking about, what do we see our personal investment life being in 5 years' time? Because it'll just go like that.
Yeah.
We see it with our kids all the time, right? My kids' youngest is 10 and I've got 13, 16. What if I was thinking more back at 10 years ago? We have to get that as the kick up the arse to keep going.
Yeah. And if you don't, you are burning your money to the ground. I cannot stress this enough. Like, it's going to get harder and harder to live. Think about how much a trolley of groceries cost when we were kids. You could fill an entire trolley for $100, $200. Yep. Now I get a bag, like a paper bag for $150 of like 15 items. It's crazy.
Yeah.
And it's only going to get worse.
That's right.
And the beautiful thing about property is, if you have the right team and the right goals and the right structures and the right strategy, it's exponential. You know, like, if you had told me 5 years ago that I'd have $8 million property, I'd be like, you're a fucking idiot. No way. I can't afford that. But this 8 million is going to turn into 20 in the next 5. It will take 5 years to get to 8, and then it'll be 25 in the next 5. And it would just exponentially grow. And I can see how, with the right strategy and structure, Rosie and I can have $100 million portfolio, you know?
That's right. So when we're starting to talk about these big concepts of $8 million property, $25 million, $100 million in property, I might even today come across as like, I'm like a computer and we go structure this and LVR that and all the crappy language that you may not understand.
Yeah.
But I'm this conduit between being crappy language and banking language all the time, and being a bit more human to be able to bridge that gap. So I might talk a little bit technical, and then I'll talk a bit more personal about how your goals are, but you need that person in the middle to help you out.
Yeah, because otherwise you have to do it on your own. And it's a lot faster to have an expert who's walked the path.
That's right.
You know, I'll tell you right now, I don't have time as a business owner to talk to banks. I don't have time as a business owner to find properties. So I go and find people that are the best in Australia at doing that. And I either pay them money or I ask them for help to do it.
That's right.
And what I love about mortgage brokers, really good mortgage brokers, is you guys don't actually charge anything. People don't realize that, right? Like, if you've never bought a property before, you don't pay a mortgage broker. The bank pays them for you. So if you get a good mortgage broker, it's free. And it can open up so much financial freedom for you. Obviously, having the right accountant, having the right buyer's agent, very important. We've got an interview with Goose launching soon, who's helped me buy these 8 properties. But I think for anyone listening, whether you want to grow your property portfolio or not, whether you have 0 properties or 3, go and talk to an expert who can tell you where you really sit. Go and talk to an expert who can help you figure out what your borrowing capacity is and what's possible. And you don't have to pull the trigger on what's possible, right? I've had clients I've sent to you who could buy 8 properties in the next year. And they're like, I'm going to try 2 to start with. Great.
Absolutely.
But they didn't realize they could buy 8.
Yeah.
They had no idea, right? And there are many examples of that. So we'll talk about where to find you. We'll drop a link down below for people to get like an assessment. We'll put together an assessment of how to actually know where you sit financially, what your goals are, what your borrowing capacity is. And I think you're also offering listeners the opportunity to talk to your team at no charge and build out a bit of a game plan. Right?
Absolutely. The all roads at any of the calls that we have together, all roads lead to borrowing capacity.
Yeah.
But once we know your goals, then we can structure that around your circumstances. Let's not play the game of what is borrowing capacity. Let's go for you strategically around what your circumstances are.
Yeah.
And definitely have a link. You can book in directly with the staff, and even me if there's space as well. If they're lucky, right?
I don't want you taking too many clients because you're my guy.
I'm yours. So so my team are property investors. We do lending every day in, day out for property investors for first time through to multi-million, and we're happy to give you a conversation and a map out of a strategy.
Yeah, and I honestly stand by what you guys do, and I'm not just saying this to anyone listening. Aaron and his team, combined with the rest of my other elements of my team, have helped me build a life where I truly have freedom. Sure, I work a lot. Sure, I grind. But if my business was to die tomorrow, I know that I'll be okay. And more importantly, my daughters and my wife will be okay.
Yeah.
And I can't tell you how much as a business owner that makes me feel safe and certain. I still feel stressed, still feel like I should be further ahead, but I also know that I'm good. And as a business owner, you deserve to feel that. So if you want to know more about property, if you want to know where you sit, go down below. We'll drop a link, fill out the forms and book a call with Aaron's team. It's no obligation. You don't have to do anything, but just create some clarity on your financial freedom. I implore you. Now, is there anything you want to leave the listeners with to really wow them before we finish this up? Anything they need to know that we haven't covered today, or any last piece of advice?
So I would say get your borrowing capacity done. That will open your mind to what's possible, and don't think it's dangerous to get more debt. It can be with the wrong advice, but don't think it's dangerous. Go with your eyes wide open. Go with an ability to make choices that you may not have thought were possible, whether it's converting your own home into a rental or even buying property and selling it, which can be a dirty word in Australia. So go eyes wide open, have the conversation. It's free to spend. Depending on who you are, it depends on things. So it's free to spend half an hour with us to get your borrowing capacity underway or some goals extracted out to see what you want to do. And you don't necessarily need to do property, but it is a massive, massive opportunity lost if you don't.
Exactly. And you get to have a strategy. You get to have a strategic mortgage broker. Right. So if you're listening to this right now, go to the link down below, talk to Aaron and his team, and get a strategy in place, regardless of who you work with. Do something.
That's right.
Amazing. Thank you so much.
No worries.
If you want to actually take this framework that I shared and apply it to your life, it's part of our Empowered Man Armory and our app that we've spent almost 250 grand on. If you want access to a powerful system where you can use this reframe system I just shared with you every single day, then find me on Instagram at Tony Empowered Man. TonyEmpowedMan. I'll put the link down below as well. Send me a DM saying reframe, and I'll give you this exact framework as well as early access to the Empowered Man app when it launches.